Let's examine how we can prepare the statement of cash flows using both the direct method as well as the indirect method. The direct method is a straightforward approach where each cash transaction is recorded in the appropriate section of the cash flow statement. Under the indirect method, we'll start with net income and adjust for accruals to arrive at the cash flow for operations. Note, the investing and financing sections are the same under both methods. Let's work on an example. Assume there are two events. First, the firm will make a credit sale of $100. Then it will collect $70 in cash from its customers. For the first event, when we make the credit sale, our accounts receivable goes up because we're expecting to receive cash, and we can record revenue of $100. In our T account, we'll have two accounts, one for accounts receivable where the beginning balance is on the left-hand side or the debit side, and revenue, which will close into the retained earnings account. Its beginning balance will be on the right-hand side or the credit side. Event 1 increases accounts receivable by $100, so we put it on the debit side, and we credit revenue, so we have $100 go on the right-hand side of our revenue T account. Next, we think about event 2, which is a cash collection of $70 from the customers. Cash goes up, so we debit cash for $70, and we're no longer expecting to receive all the money from our customers, so we can credit our accounts receivable by $70. Now we can introduce our cash T account where the beginning balance is 0 on the left-hand side. We put $70 on the debit side of our cash T chart and $70 on the credit side of accounts receivable. That's all the transactions that we have, so now we can find the ending balance. We record a $70 ending balance for cash and a $30 ending balance for accounts receivable. On the credit side, we have revenue, which reports an ending balance of $100. So our total debits, 70 plus 30, equals to 100, which is the total credit. Let's prepare the statement of cash flows using the direct method. Let's take a look at the cash T account. The beginning balance of the cash T account is 0. Cash collection from our customer increases our cash account by $70. So we can record the $70 as cash inflows from our customers. We don't have any other cash activities, therefore this is all the cash that we have. Hence, the cash provided by operating activities is $70, which is the money that you received from your customers. There are no other events related to cash. Therefore, the cash inflows from customers of $70 is the cash provided by operating activities. Cash flow from investing and financing activities are 0 as well, since there are no cash events that deal with investing or financing activities. The sum of cash flows from operating, investing, and financing activity is $70, so that's the change in cash. Let's take a look at the cash T account. Notice that the beginning balance is 0 and the ending balance is 70, so the change in cash by examining the cash T account is also $70. So this is what a statement of cash flows would look like under the direct method. We can also prepare the statement of cash flows using the indirect method. What we're going to do is we're going to find net income, depreciation expense, and or amortization expense, gains and losses from the income statement. And from the balance sheet, we're going to find any non-cash operating assets as well as operating liabilities. We start off with net income. We add back depreciation expense / amortization expense, subtract gains, and add back losses. Notice that depreciation expense and losses both reduce net income, so we add them back. They have the same sign. And in contrast, gains increase net income, so we reduce it. Depreciation is recorded as depreciation expense and has no effect on cash. However, depreciation, like all other expenses and losses, reduce net income. Therefore, to convert net income to cash flow, we add back depreciation to net income. Similarly, we add back losses to our net income. This way, the add backs will cancel the earlier deductions. We will subtract increases in non-cash operating assets and add decreases in non-cash operating assets. Notice these are opposite in sign, so we subtract an increase and add a decrease. For operating liabilities, we'll add increases in operating liabilities while subtracting decreases in operating liability. Notice the signs are the same, so we add increases and subtract decreases here. We can think about why an increase in a non-cash current asset decreases cash. Let's take an example of making a sale on account. Accounts receivable is increased, but cash isn't affected yet. So we must subtract the increase in accounts receivable to get to the cash because we haven't collected it. Therefore, if operating assets increase, cash decreases. We can also think about why an increase in a current liability increases cash. Let's take an example of accounts payable. Let's imagine a firm's accounts payable increased. That can only occur if the cash was not spent to pay this debt. Cash payments are therefore less than expenses, so that means the firm has more cash on hand. Thus, increases in current liabilities increase cash. We then arrive at the cash flow from operations. Let's go back to our example and prepare the statement of cash flows using the indirect method. We will start off with net income. Our net income comes from our revenue account, which is $100. So we can record the net income of $100 on our statement of cash flows. Let's think about accounts for which we have to make adjustments to reconcile net income to net cash. The non-cash operating asset is accounts receivable. The beginning balance was 0. Event 1 increased receivables by 100, while Event 2 reduced it by 70, so the ending balance is 30. The 30 ending balance minus the 0 beginning balance means that our accounts receivable has increased by $30. So we're going to subtract the increase in accounts receivable, and we're going to reduce our net income by $30. Hence, this would give us a cash flow from operating activities of $70. Notice that the cash T account has an ending balance of $70, and our cash flow from operating activities is also $70. This is because the cash from investing and financing activities are 0. Therefore, the change in cash is once again $70. Let's compare the statement of cash flows prepared under both the direct method as well as the indirect method. First, notice that the cash provided by investing and financing activities are 0, and the change in cash is $70. They look identical under both the direct as well as the indirect method. Cash provided by operating activities is $70 regardless of whether we use the direct or the indirect method. So the major difference between these two methods lie in the presentation. Under the direct method, we see cash inflows from customers. Under the indirect method, we start off with net income and we subtract out the increase in accounts receivable. Let's take a look at another example. The firm makes a cash sale of $100. It buys property, plant, and equipment for $40. Later, it'll recognize $10 of depreciation on the PP&E. With the cash sale of $100, we debit cash for $100 and credit revenue for $100. In our T accounts, the cash beginning balance is 0, and Event 1 increases the cash by $100, so it goes on the debit side. We'll put revenue inside the retained earnings account, the beginning balance for retained earnings is 0, and from event 1 through the revenue, our retained earning goes up by $100. When the firm buys PP&E for $40, PP&E will go up and cash will go down. Therefore, we debit PP&E and credit cash. Finally, the firm will recognize $10 of depreciation on the PP&E, so we'll debit depreciation expense for $10 and credit the contra asset account accumulated depreciation for $10. In our T-charts, we can find the ending balances after all three events have been recognized. The ending balance for cash is $60. The ending balance for PP&E is $40. The ending balance for accumulated depreciation is $10. And the ending balance for the permanent retained earnings account is $90, arising from $100 due to revenue and $10 due to the depreciation expense. Now we can prepare the statement of cash flows. Let's work on the direct method first. When the firm made the cash sale, it receives $100 in cash from its customers. We can record this cash inflow from customers onto our statement of cash flows. The company spent $40 buying property, plant, and equipment. We can record the payment for the purchase of PP&E on our statement of cash flows. The cash flow that we receive from our customers is classified as an operating cash flow. The cash payment for the PP&E is classified as an investing cash flow. Note that when we see a positive cash flow, we'll use the terminology provided by. In contrast, when we see a negative cash flow, we'll use the terminology used by. There are no other transactions, therefore the cash provided by financing activities must be 0. Summing the cash provided by operating activities, cash used by investing activities, and cash provided by financing activities, we find that the change in cash is $60. Looking at the cash T account, we note that the beginning balance for cash was 0 and the ending balance is 60. This means the change in cash is also $60. We have prepared the statement of cash flows using the direct method. We can prepare the statement of cash flows using the indirect method. We always start off with net income. From our retained earnings permanent account, we find that the net income is $90. It is $100 from the revenue, subtracting out the $10 of depreciation expense. Next, we can add back the depreciation expense of $10. Therefore, the cash provided by operating activities is $100. Remember, the only difference between the direct method and the indirect method is in the operating section of the cash flow. Therefore, the investing and financing section, as well as the change in cash, look exactly the same as before. Under both methods, the cash provided by operating activities remain at $100. The only difference between the two methods is in the presentation. And now you know how to prepare a statement of cash flows using both the direct as well as the indirect method.